Hello everyone, welcome to MastersTeach and Strategic Financial Management. Listen carefully. These 5 chapters I made in simple manner. Okay, so try to take the notes and try to remember. And strategic financial planning. So what is it? We'll see here. The strategic financial planning is a processing of align financial resources with the long-term corporate goals. Every corporate, every company, every organization have some plans. So some goals are there. In order to meet that goal, you need to have proper financial planning. So, according to the goals, you have to prepare the financial thing that is called as strategic financial planning. Strategy means like how you are going to do the things. Okay, uh, like we already discussed in strategic management. So, what is the objective? The objective is that in order to create the maximum wealth for the shareholders, so proper amount should be there, and whatever the capital, whatever the amount is there, that should be used properly. Then importance, it due to proper financial planning or strategic financial planning, so it guides the investment as well as financing and dividend decisions also taken. Corporate goal. What is the goal? In order to run the company profitability and growth sustainability. Then it should have run in a long term. This is about the strategic financial planning. Okay, what you have to do in that planning, there are process of financial planning. So you have to write set goal. What the goals, what is the goal of a financial goal of a company in financially. Then what is the resources? Okay, internal resources, external resources, what is the financial resources, and you have to use a formulation strategy. So how you have to use that particular plan for the expansion of the company or diversification of the company, and you have to implement and execute the same. So when they are asking about the financial strategic financial process, so you have to write these particular information. Then try to write this financial planning process. This entire thing you have to write so that you will get maximum marks. So how the financial funding can be happen through equity shares. Okay, that is the own funds, through debt, through debenture, and or retained earning. Already the company has the earning that can be used. So this is a strategic financial planning. I simplified. Don't forget to write all these. Okay. Then what is the corporate strategy for growth? Okay, how the company can be grown. Okay, one is growth strategy, internal growth, external growth, diversification, integration. So internal growth means expanding using own resources. You want to grow the company, but you want to have the funds. So whatever the your savings are there in your company, okay, that can be used. External growth, so the company can be grown by mergers with the other companies or acquisition by taking over the other company, or joint venture, have the partnership with the other companies. This is the external growth. Then diversification. So for example, enter into the new market or new product. Okay, for example, many things. Okay, nowadays the shoes company enter into real estate. Okay, that is the thinking. For example, our real Reliance industry, previously only they produced textiles, but nowadays they entered into the oil as well as internet and everything integration. So horizontal as well as vertical consolidation, how the funds can be raised, how the amount is required can be raised. So right issue. So if you already knows about the share market, so the new shares offered to the existing shareholder at discount, that is the right issue. Then IPO, initial public offer. So first time when the company listed, the initial public offer. Then private placement. So the whatever the shares of the company, they'll sell to the selected customer. Then venture capital. So like in order to grow highly, they'll get the funds from venture capital. So corporate strategy for growth, you have to write about this growth strategy and fundraising method. Then features here, features IPO, right issues and private placement. So in IPO, the investor is general public, initial public offer we invest, then right issues which will be given to the existing shareholders, then private placement. So you have to select the which institutions, then regulator. So IPO is regulated by SEBI, whereas right issues also regulated by SEBI, but it's a moderate, and private placement they can get the funds from anywhere, so regulator may not be there. The cost, IPO has cost is huge, then right issues low, and private placement low. Okay, then speed, IPO in order to get the amount it is very slow, whereas right issues it is a moderate, and private placement is a very fast process. Then capital structure planning. Okay, it is a shoe shot question. What is capital structure? It is a mix of equity shares, preference shares, and debt, like debentures. Okay, so equity, it is a own shares. Okay, so there is no fixed. It is a high risk for the customer, but you need not to pay again to the customer. Preference shares, only the dividend is paid firstly. Okay, you have to write this capital structure: equity, preference shares, debt. So debt means borrowed funds, fixed interest, okay, tax deductible, etc. So why this? Why we need capital structure? For the business needs, for assess finance, in order to decide the capital mix. Capital mix means three: equity, preference shares, debt. Okay, this is the thing. Then understanding the debt financing. What is the debt financing? So you are going to borrow the funds from other source. Okay, here what is the other source and other stuff here? Uh, Debt. Okay, debt finance means rise, rising the finance funds through borrowing, through loans, bonds, debentures. Debt policy. So, what is the guidelines for the policy? And debt to securitization. So, you have the loan and you have to convert into the securities. Then syndication. You are going to get the loans or funds from different thing. So, multiple lenders jointly funds the loan amount. Then pecking order theory. So firms prepare to internal funds, then debt, then equity. Okay, this is the thing. So what is the advantages having the debt funds or loan fund? So they have the tax on interest. There is no tax in this. No ownership dilution. Ownership will not go cheaper than equity. What is the disadvantages? So every time if you take the debt, okay, you have to pay regularly, so financial risk will be improved. Sometimes company go into the bankruptcy. Then this is also important, my dear friends. EBIT and EPS analysis. What is EBIT? It is the earning before interest and tax. What is EBIT? Earning before interest and tax. So it is operating profit. What is EPS? Earning per share. So the formula is net profit divided by number of shares. Indifference point, EBIT level where EPS equal under the two financing goal. Remember this. So how this can be leveraged or unleveraged? So unlevered beta, it is a business risk only, no debt effect. Leverage beta, it is a business plus financial plus include debt. Okay, So you have to write this simple example. Plan A. Okay. EBIT is a 1 lakh and shares has EBI share has 10,000. So 1 lakh EBIT divided by shares equal to EPS, earning per share is at 10 rupees. Then plan B, debt plus equity. EBIT, earning before tax, okay, what is 1 lakh, and interest 2 lakhs, 20,000. So the number of shares is 5,000. So EPS equal to this one, 16. Indifference point. Okay. So here it is mentioned here. Find EBIT plus EPS A equal to EPS beta B. So solve algebraically. Try to write this EBIT, EPS, then corporate acquisitions. Sometimes the company acquires other companies to gain the control to have its operational assets. So why corporate acquisition means you are acquiring, you are controlling other company to gain control over the operational assets. So the objective is market expansion, then synergy gains. So in order to eliminate the competition, acquire technology, etc. Then uh, then friendly acquisition. What you does, you discuss with the board members and you deal the same. That is friendly. Hostile acquisition. So bypass the agreement, directly approach the shareholders via tender offer. There is a hostile acquire. For example, Tata Motors acquiring Jogger Land Rover is a friendly across board acquisition for the global access. Okay, then we'll see mergers, meaning and types, etc. Types of merger. So remember, I'll zoom it. The types of merger, it is horizontal. In the same industry, two banks are merged. For example, Union Bank of India and uh, other corporate bank. So the merger, there is a horizontal. Vertical, so buyer and supplier merges. Conglomerative, unrelated businesses. For example, those who are in gold business, suddenly they enter into the software. Those who are in the oil business, Wipro, it was oil business. Now they entered into the software industry. Then reverse merger. So private merger with a listed company. That is a reverse merger. Try to write what is the types of merger. Vertical, conglomerate, then reverse merger. Reason for merger, in order to have synergy, they want to expand and economies of scale, tax benefit, market power. So exchange ratio here, uh, this is the thing. Just wait. Yeah, exchange ratio, number of acquiring company offered per shares. Formula, exchange ratio formula is price offered per target share plus market share acquired shares. Example, offer price is 150 per share, acquired price is 200. There the ratio is 1 is to 15. So combined equity means when their equity is combined, these are the benefit. Okay, okay. Then we'll have the dilution and acquisition of earning. So dilution means uh, post merger. So after merging with that, equity per shares shall fall. Okay, it is a pre-merger EPS bad signal, whereas accretion. So post merger EPS rise above the pre-merger EPS. There is a good signal. Important. So whether the merger creates destroy shareholders value or increase the same. This is a dilution or accretion of earning. So evaluation of merger, calculate the combined net profit and merger, then calculate the total shares including exchange ratio. Then step 3, new equity per shares equal to combined profit by total new shares. And step 3, compare EPS with the old EPS, accretive or dilutive. So try to remember the same. Then consolidate balance sheet. Consolidate means combining of the balance sheet. Consolidated balance sheet combines the assets and liabilities of a private company with the subsidiaries. For example, this is the main company, okay, parent company, and this is a subsidiary company, and you are going to consolidate. Okay, so your main company plus its parent, like child company or subsidiary company, it become consolidated. So why it is happen? So assets and liabilities to be combined. So like intercompany transaction can be done. So the goodwill also can be done. Then minority interest separate. This is the thing. Then corporate valuation. So company need to be valuated. Corporate valuation is the process of determining the economy worth of a company. For example, uh, like merger acquisition, investment, strategic decisions. So in order to have the company valuation, okay, they will calculate the valuation before mergers, acquisition, investment, or strategic decision. Asset approach. They will calculate the assets. Net assets formula is here. Total assets minus total liability. It is the asset for the heavy company. Income approach. Value based on for future earning cash flows. Okay. Then market approach. So value based on compare other companies market price. So this is the P ratio can be done. The company value can be done, valuation can be done by asset approach, by income approach, by market approach. Remember. Then equity free cash flow, EFCF, equity free cash flow. So what is the meaning? So equity free cash flow, EFCF, is the cash available to the equity shareholders after all expenses, reinvestment, and uh, debt payment. So the cash is available after paying to the uh, all expenses, investments, and debt holders. So the final amount will be given to the shareholders. That is called equity free cash flow. How it can be done? Uh, EFCF equal to net income plus depreciation minus capital expenditure minus change of working capital minus debt payment plus debt interest. So it is can be used to decide the uh, dividend capacity before merging anything. Okay, simple example here. Try to remember net income plus depreciation, capital expenditure, change in working capital, debt investment, debt repayment. So it will be the EFCF, equity free cash flow. Okay, there is a thing. Discounted cash flow. So discount CDCF, discounted cash flow. So DCF value company by discounting the future cash flows to present value discounted rate. Okay, this is the thing you have to remember. Okay, then value based management and EVA. So value based management and value added, the economic value added. EVA means economic value added. What is exactly meaning of value based management, VBM? Managing a company to maximum shareholders value in every decision. Whatever the decision taken in the company, it should maximize the profit to the shareholder. That is called value based management. Objective is that align the goals with the shareholders interest. Whatever the shareholders goals are there, according to that it can be done. Benefit: better capital allocation, improved performance management. This is a value based management. Okay, so economic value added is EVA. This is the thing you have to remember. Okay. Then corporate restructuring. This is a sure shot question for your examination purpose. What is restructuring? Okay, reorganizing the company's operations, finance in order to improve the value of the company. Okay, some companies working very badly and going in losses, how you have to reconstruct, that is called as corporate restructure. Improve the profitability and competence, so reduce the cost, eliminate the inefficiency, respond the market changes to financial research. So corporate restructuring means company going losses or company want to like improve their efficiency, then they will do something, okay, that is called restructuring. Identify the problem, plan the restructure, implement the changes, monitor the result. This is the corporate restructuring. So when they are asking about the restructuring, you have to make the diagram. Types of restructuring: one is financial restructuring, so you are changing the debt, equity, etc., and renegotiating loans, etc. Operation research, so downsizing your factory size, closing unprofitable branches, etc. So corporate restructuring. Okay, then change of ownership structure, so how the ownership can be changed of a company. So one is spin off, split off, split up, LBO. What is spin off? A division become an independent company, shares given to existing shareholders. So one company is there, and for example Tata Motors, which is divided into Tata passengers vehicle and Tata commercial vehicle, that is called spin off, split off. So shareholders exchange parent shares into new subsidiary. For example, company started A and it is going to be have one more company subsidiary B. So there is a new, that is split off. You're going to split the things. Okay. Then split off. Parent company breaks into two or more separate companies. Parent ceases to exit. Okay. One company is there which is divided into two or more companies. So the parent company no more existed. What is LBO? Leverage buyout, acquiring the company using mostly borrowed funds, assets as collateral. Means you are going to acquire the new company, okay, with the your borrowed funds, with the loans you are going to acquire. So methods: spin off means parent company exists, keep both the shares. Split off, parent's company is there, then it is existed, exchange rate, then split off. So parents company will not there, they are going to have the new company. LBO, so acquiring the using like parent company is there, new private owners will be there. This is the thing. Buyback of the shares means the company buy back or repurchase its own shares from the open market from the shareholders. So what happened? Equity per shares will be reduced. Then by reducing equity per shares will be increased by reducing the share count. So it is return surplus. Whatever the return is there, that will be given to shareholders. So it is a signal for undervaluation to the market. So it is in order to prevent other people to acquire the company. Is the buyback of the shares. So methods of buyback: methods open market purchase, then OMP, that is open market purchase, then tender offer, book building, fixed price offer. Limitation. So what happened? So it reduces the cash reserves and lack of growth may happen, and regulatory restriction may be there. Who is the regulator? SEBI, Security Exchange Board of India. For example, Infosys regulate buyback shares to reward shareholders and boost EPS. That is the thing. Then, what is the problems in corporate restructuring? Financial problem is there. Okay, when you are restructuring, bad debt may go, then like difficult to raise the new capital, etc. Legal issues. So SEBI required, CCI approval required. It's a complex process. Then employees issue. So when the restructuring is there, so some people may lose their job, some people protest the change, then they lose the moral on the company. There is a disputes between the people. Then shareholders a market issue. Shareholders opposition, then market uncertainty, stock price volatile during the period. So, for example, corporate restructuring, Kingfisher Airlines, okay. So everybody knows about this. So they want to restructure the same, but the like debt was more, a regulatory issue was there. So end of the day, the company got closed. Okay, problems in corporate restructuring. Then what we have done, strategic financial planning, we discussed what is the financial planning process, IPO, right issues, and etc. Then corporate structuring, we discussed equity, debt, and EBTI, EPS, etc. Then acquisition merger we required. Then corporate valuation we required. Then corporate restructuring we discussed. Okay, so these are the important point. Try to take the screenshot and study the same. Okay, so thank you for watching Masters Teach. We'll meet with the next lecture. All the best.